In the previous episode, we established that strong systems are designed backward from the future. We showed how future state goals, investing benchmarks, and required recurring investment flows reshape lifestyle decisions, leverage tolerance, liquidity requirements, and recurring surplus targets. But eventually, another critically important question emerges. Where should the capital go first? Because not all investments, purchases, or capital deployment decisions create the same future state outcomes. And this is where strategic capital allocation becomes critically important. Capital allocation is fundamentally a prioritization problem because every dollar can only be deployed once. This means every allocation decision creates trade-offs, constraints, and future consequences. For example, a recurring surplus can be allocated toward emergency reserves, debt reduction, retirement investing, education, productive assets, business ownership, speculative investing, or lifestyle expansion, just to name a few. But choosing one pathway often means delaying another. This introduces one of the deepest ideas in finance and economics, opportunity cost. Opportunity cost means choosing one future requires giving up another. This becomes extremely important in adaptive financial architecture because luxury vehicles, oversized housing, recurring subscriptions, and lifestyle inflation may not merely reduce current liquidity, they may reduce future optionality itself. This is why strategic households evaluate decisions differently. Instead of asking, can we afford this today, they increasingly ask, what future does this decision delay or eliminate? That is a profoundly different way of thinking. One of the most important distinctions in strategic capital allocation is productive versus consumptive deployment. Productive deployment tends to increase future earnings capacity, expand optionality, improve resilience, and strengthen adaptability. Examples include education, skill development, business ownership, productive investments, health optimization, or systems that improve future cash flow generation. Consumptive deployment often prioritizes current experience, current comfort, or present identity signaling. Again, this does not mean all consumption is bad, but structurally, strong systems intentionally prioritize future flexibility creation. Over time, many strong systems develop allocation hierarchies, meaning certain categories receive capital before others. For example, Tier 1 may include emergency reserves, liquidity stabilization, and structural survival. Tier 2 may be high-interest debt reduction, risk reduction, and recurring cash flow improvement. Tier 3 may include long-term productive investing, retirement systems, skill development, and future state funding. And Tier 4 may be optional lifestyle expansion, luxury consumption, and lower priority consumption. This sequencing matters enormously because fragile systems often expand consumption before foundations are stabilized. Another critically important distinction is speculation versus strategic investing. Speculation or speculative systems often prioritize excitement, rapid upside, short-term gains, and emotional volatility. Strategic investing systems prioritize consistency, survivability, long-term compounding, and adaptive resilience. This is very important because compounding only works if the system survives long enough. Strong systems therefore often optimize for sustainability, repeatability, and downside protection before aggressive upside maximization. Ultimately, the deepest purpose of capital allocation is not merely maximizing returns, it is constructing future flexibility. Strong capital allocation systems gradually increase resilience, freedom, adaptability, and strategic choice. This is why the strongest systems often appear disciplined, patient, and structurally intentional. because every recurring allocation decision slowly reshapes the future state architecture of the household. Over time, strong systems begin creating positive structural feedback loops, where recurring surplus funds productive investments improve future capacity, improved capacity generates larger recurring surplus, and expanding surplus increases future optionality. This is where adaptive financial architecture begins transforming into self-reinforcing compounding systems. And this is why small recurring decisions become so important, because eventually the structure itself begins determining resilience, adaptability, and future freedom. At this point, it's important to recognize that this entire 11 series of Season 3 is gradually building toward, because ultimately all of these concepts, recurring surplus, liquidity, investing, leverage, capital allocation, and optionality, need to become measurable. And that means the next major evolution of adaptive financial architecture is quantitative benchmarking. So far, we've established that strong systems generate recurring surplus, preserve liquidity, fund the future intentionally, and allocate capital strategically. But eventually, every household must be able to answer, where do we actually stand? Because benchmarking only becomes useful when the current structure, the target structure, and the gap between them can all be measured clearly. This is where the framework begins evolving into a complete adaptive financial benchmarking system. A system capable of measuring operational adaptability, liquidity strength, leverage pressure, future state funding adequacy, and overall optionality capacity. And importantly, these dimensions do not exist independently. They interact dynamically, which means the goal is not merely optimizing one ratio, the goal becomes balancing the entire system. In the next episode, we introduce the adaptive financial benchmarking framework. We'll begin constructing measurable target ranges, resilience thresholds, optionality benchmarks, and visual adaptive architecture dashboards, including the spider diagram optionality maps that visually reveal structural strength, hidden fragility, imbalance, and future flexibility capacity across the entire household operating system. Because ultimately, strong systems are not accidental. They are benchmarked, measured, stress-tested, and intentionally engineered over time. And the strongest systems of all are not necessarily the wealthiest or the highest income. They are the systems with the greatest future optionality.